calling the Investment Advisory Committee meeting for Monday, February 6th, 2023 to order. Calling the roll, Executive Ronayne. Here. Councilman Shrine.
Here.
And I, Chris Murray, also here. We will move immediately into the approval of the minutes. If you have not had a chance to review them, take a moment now, please. And after you're done, I will entertain a motion for approval.
Move we approve the minutes as submitted.
All right, it's been properly moved and second. All of those signifying aye.
Aye.
Aye. Motion carries. Okay. We will now move into the organizational matters before the committee. And at this point, the only organizational matters are the estimated IAC meetings for this calendar year. April 27th, we'll be reviewing the first quarter 2023. July 27th will be the second quarter, and then October 26th will be the third quarter. As always, the IAC meeting dates are penciled in, and so if the members of the committee have an issue with the date, we can certainly move it. Any questions about the proposed IAC meeting dates at this point? Okay.
Yep.
All right.
At this moment, they're all open on my calendar.
They're all good? Okay.
As of this moment.
Okay. We won't hold you to that. We won't hold you to that. Okay. Now moving into the public comment of the meeting. Is there any public comment? Chair recognizes Mr. William Tarter. Can you introduce yourself for the record?
Is your mic on?
Yes.
Same as
green light. Sorry about that. Okay.
William Tarter, resident of Broadview Heights. Just here as a representative of the public, just want to say thank you so much for moving the room and to aligning this meeting with other committee meetings that are live streamed on the YouTube page. It's a tremendous civic education opportunity for members of the public, and I appreciate the county executive for his leadership, and to the chief and the treasurer and all those who helped to make this possible. So thank you very much.
Thank you. All right. Seeing as there's no additional public comment, we will now move into the portfolio review of the agenda. You will see on page 4 of your agenda, you'll see the portfolio compliance and allocation report. What this simply provides for the committee is our investment amounts by type for the fourth quarter of 2022. The first section of the report is our more liquid overnight cash, including bank deposits, Star Main. We have 3 additional Star accounts, which I will discuss briefly, as well as our custody sweep accounts. And the custody sweep accounts are the accounts that our investment advisor uses to make our purchases. So as in a business sense, we once an investment matures, I should say, the investment advisor sweep that account and then use the monies in that account to make the next available purchase based on their recommendations. So that's why those amounts that you see are relatively small compared to the rest of the portfolio. Bank deposits themselves, as some of on the committee are aware, that is essentially 3 of our depository banks, Key Bank, PNC, and U.S. Bank. Star Main is our is our primary overnight investment vehicle. It is a program that is administered by the state of Ohio, and all treasurers, well, most treasurers invest their overnight money with the state treasurer because of the yield opportunity. The federal government, through various actions on their part, created additional funds for the county. One of them was the American Reinvestment Act. Another one was the CARES Act, which was changed and rebranded to development. And then also finally, there was an opioid settlement that was provided to the county. So the administration made the recommendation to create separate STAR accounts for these. And so these funds are available for the prescribed purposes of their intent. So as an example, there is a slate of projects that STAR ARP is designed to pay for. And so, and as a business process, we supplement any monies that we need out of STAR Main. Once we get to those portions of the year where there are expenses tied to, for example, STAR ARP, we transfer that cash from STAR ARP to STAR Main. And that's the way that we have been able to account for the money. So as you can see, this is what we have available overnight. Any questions about the STAR accounts before I move on?
Mr. Chairman, the
Yes.
STAR accounts, they're all liquid.
Mm-hmm.
And if I look back on the last page, does that indicate where our interest rates are roughly in regards to those, or are they going to be lower than those for those three accounts?
They're going to be higher than those for those three accounts. The STAR will be discussed by the interest rates on STAR will be discussed in the portfolio review that is provided by our investment advisors later on in the meeting.
I got what they are, but
Yep.
I assume as you as treasurer would know that.
Yes.
What are those rates?
Right now, STAR is about 4.5%
Okay, so we're making 4.5% of those right now.
at this point.
Yeah, okay. I realize it's
At this
daily.
point.
It's
At
daily.
this point,
It's
right.
daily.
At this point. Mm.
Okay, and then of the opiate funds,
Mhm.
the $35 million that's sitting out there, it was my understanding that the previous county executive had basically set aside $10 million, of which that was going to be put into two buckets, this amount and $10 million into the opioid innovation fund. Only 5 was used in the original funding of the opioid innovation fund. Is this 35 broken up into two buckets still? Into an opioid innovation fund allocation amount of $5 million as a follow-on as part of the $30 million?
I'm not aware if the two buckets are comprised in the overnight or if they are in the long-term portfolio.
Okay.
I could certainly
Sorry, I just
find
wanted,
that out, Councilman.
my primary purpose is that one of the assurances was that if we can produce additional outside money to match that, the commitment of council was that they would support the county executive's desire to put 10 million in there. There are, I believe, conversations taking place from outside, not I believe, I know there are conversations whether they materialize to get that matching $10 million. I want to make sure that we could actually track, the trail on 5 million is there and not spent someplace. I mean, obviously, it's my desire as the moving party to want to make sure that we grow this to the point where it can be impactful and that we can do stuff. So if we get to the point where you have needs for it and it gets spent, then it gets spent. But in the meantime, I would like to hope it's still being tracked as a separate item in there.
Okay.
Thank you.
I will check with OBM on that.
While we're asking questions, Mr. Chair, just new guy on the bank deposits question. How often and how do we go about making the decision on our bank deposit partners? And the third one you mentioned was Key PNC and Dollar. What was
Key, PNC, and U.S. Bank
Sorry, US Bank.
comprise the 13 million that you see
Okay.
on the agenda. Yeah.
what's and I can ask you for greater in-depth answer later, but just generally speaking, what's the process at which we determine who we work with and how often does that happen?
It's an excellent question. We, every 4 years, there is an RFP, which is let, and myself, along with a couple of members of my staff, take the time to review the RFPs. Obviously, we're looking, we've got a couple different things that we're looking at. Number one is how well the banks will assist us in terms of operations. Just to give you an example, the current bank that we use as the main depositor, they provide us a lockbox service, which allows us to process real estate tax payments, and it allows me to maintain a staff of 3 instead of 7 in previous years.
Gotcha.
It's very important.
And where are we in that 4-year cycle?
We are coming up on the end of the cycle next year, April 24.
Gotcha. And last question is on the policy limits, just walk me through referent to what? Is that as if to say the ones that are at 100% could assume 100% of
Of the portfolio.
that entire portfolio?
That's correct.
Interesting.
That is correct.
Okay. Well, thank you.
Okay.
And then following on the county executive's questions about funding usage, we had created a fund opportunity to whereby we invest or would take needs from school boards and from communities.
That's correct.
And I know that at this point, we're still looking at how can we market that to be effective. Clearly, if our average balance is making 1.85 across the board, if we can get 3, 4, we would be making money on behalf of the taxpayers in this respect. How much money could we be allocating towards that utilization of our portfolio?
Well, the policy limit itself, if I understand your question, Councilman Shrine.
Because the county executive new to this, so I
Right.
want him to have an
I appreciate
understanding.
it.
Absolutely.
Yeah, thank you.
The policy limit is 20%. Right now, we are at 2.8%. That is because our selection of municipal notes and bonds is really based on an entity coming to us. To Councilman Schron's point, we have not really been in position to market our infrastructure program that we have. It is, a layman would probably consider the policy to be rather tight in terms of protecting the county's interests. Certainly, the opportunity is there. In our portfolio at this point, I mean, we have county issues. We've got Franklin County, City of Columbus. I think there's some libraries. I know I'm missing some, maybe City of Hudson. So the way the process is working now, an entity of a municipality is going to have to come to us. Our investment advisors who will be on the call, Meter and Associates, Meter Investments, they review those and then they provide us the recommendation. But we have not, to this point, marketed the program as a way as a financing vehicle for other state governments.
And the amount of money that,
Other local governments.
yeah, and the amount of money that would be talking about is 20% of the
Total
corpus.
portfolio.
So we're looking at $250 million, an additional 2%, 2 points of potential earnings. And the lever that we have, the way it's written, as I understand it, as I recall, was we control their taxes of any municipality that doesn't want to pay us. So it's a pretty strong negotiating position that everybody they want to get a better tax rate, they want to get a better interest rate, and we want to make sure we get paid. So
Absolutely.
there's a nice 3-party relationship. You don't have to be hardball, you don't do anything. You're actually being very good to any community or school board because you're giving them lower interest rates than their bond would be even be able to sell a bond at today's escalating rates out there. So with that, I thank you very much, Mr. Chairman.
Any other questions on the portfolio compliance report? Okay. The next page is the same portfolio compliance report, but this is only for the long-term opioid cash of $60 million that at the time, there either are planned uses that are going to take some time for them to come to fruition, or money we've got set aside for other projects that may or may not have been identified. So right now, just to make sure that I tie the two together, at $60 million sitting in the long-term portfolio, as well as the $35 million that is currently sitting in our short-term investments. That's $95 million for opioid.
Thanks for clarifying, because I thought we had $100 million.
Right.
For
So
opioid.
we've spent some of it, but to your
Yeah.
point,
But we're
yes,
sitting on still almost $100 million
Absolutely.
in opiate.
absolutely. All right. All right. And then the next page.
Just
Sorry.
that,
Okay.
again, Apologies for catching up here.
No problem.
But I see the 60 is the balance. Where's the other 40 coming from?
35 is on the prior page, so that,
Oh, okay.
that's,
I got you.
we've got the 35 million in the short-term, STAR accounts, which
Okay.
are the
Oh, I see.
state treasurer
I got you.
managed funds.
All right. And the reason I stopped in my tracks on that, I had heard of $140 million, so, yeah,
We've used some of that.
Yeah,
And then 5 million went into the opioid innovation fund.
okay,
So we've used some of the 140,
okay.
but we're still sitting on just short of
100,
$100 million.
million, okay.
And it's sitting there primarily being used for treatment at this point in time.
Mm-hmm. And there's some, although this is getting into a different policy discussion, but there's some
Right.
discussion about $1 million more annually coming in from the state. Is that, am I anywhere in the ballpark?
I do not have
Okay.
any knowledge of that
Well,
at
like I
this
said,
point.
it's a different discussion, but sort of thought I heard. Okay.
There's a desire for some of us who are desirous of the Opiate Innovation Fund to grow it, that,
Yeah.
there would be money coming out of their their innovation,
All right, well,
their opiate funds. And I think
we'll follow up on
the
that.
governor would welcome that as a place to be innovative.
Yeah.
What I'm going to assume is that opioid innovation is in the long-term allocation, but I will verify that, Councilman.
I don't
To
know,
your point,
that would
it should
be
be
interesting to
shared.
be verified, because those funds have moved over to, they moved over to Cleveland Foundation, so I don't know whether we still track those or not, do we?
They're not on our books then, if they're on the Cleveland.
I don't think we do. I think now that you still
Yeah.
control the names of the people who are going to be disseminating it, but the funds are sitting in a fiduciary account, I believe, over there.
Executive, I'm not sure if in the county is different, but for cities, it was taking 26 years for those funds. Every year, we were getting allocated. So I don't know if maybe you were talking to,
Yeah, again, I'm sorry to be having, it's a little bit less than concrete, but that was along those lines. It was an annual allotment that I thought was going to come over 18 some years. Yep, okay.
Yeah,
Looking
county
at Trevor.
executive's correct. It's part of the One Ohio settlement where I think we're getting 18 million over 20 years.
Yeah,
It's
okay,
a little less than $1 million per year.
okay. Well, thank you, just getting,
Okay. So that's in
still a
addition.
fair amount of money. with
And we
that.
think it's coming to us, or is it coming to the foundation?
No, that's going to the county. It's the county's portion. It's a small amount
Okay.
of, a statewide settlement that the state of Ohio entered in with, and there's a board created to oversee those dollars.
Okay.
Okay.
All right. And the last page of my report is just a comparison of the interest rates of the portfolio. As you can see, the portfolio has rebounded from 3 years ago in 2019, and we saw extremely attractive rates. So we're not out of the woods, but the trend appears to be up with the portfolio. Any questions? All right. With that, we will now move to the portion of the agenda where we will have the overall investment discussion. And this is brought to us by our investment advisors, Meter and Associates. Jason, can you take it from here?
Actually, we're gonna let Eileen.
Hi,
we're
Eileen.
We're used to
How
the
are you?
Jason's starting this off. We'll let Eileen take the first
Okay.
stab.
Yeah.
Sorry, Eileen.
Thank you. That's okay. Great to see you. And we certainly welcome the opportunity to be able to step in with the Jasons being under the weather here today. Rest assured, you're in good hands with us leading the presentation here today. My name's Eileen Stanek. I'm a regional director with investment advisory at Meter, and Jason Zabo is assistant director of our fixed income team. So just kind of to provide a little background just on the firm, recognizing that, we do have some new folks here in the room. Meter has been in business since 1974, and we have been working with public entities since 1990. So we have a long history in this space with assisting public entities, and we're very proud to say at this time, we now serve as advisor, manager to over 300 public entity accounts throughout the country, advising on funds exceeding $42 billion. So we are certainly dedicated to this space and very honored and pleased to be able to providing our services to Cuyahoga County. As a Northeast Ohio resident, it also makes me proud to be able to be on this call here today. Yeah, representing the firm. I've been working with public entities here now for over 20 years. So time flies. So that being said, I'm going to go ahead and share the screen with the presentation. While I'm doing that, I'll let Jason Szabo give a little background on himself.
Thanks, Eileen. I guess I'll start off first with a former Cuyahoga County resident, grew up in Garfield Heights and has since moved down to Columbus, Ohio. So as Eileen alluded to, so assistant director of fixed income here at Meter, been with the firm for nearly a decade, managing and working with the strategy development, implementation across all of the entities, types, and then also the various asset classes in the states which we are working in. So with that, I think we'll open it up to walking through both the economic environment and then also taking a deeper dive into the operating fund and the opioid funds. What's starting off first is always good to level set on what's the growth picture look like. And we have two important indicators that we here at Meter, then also really the Fed and other folks within the marketplace keep a real close eye on is this Institute for Supply Chain Management. They put out two wonderful surveys to corporations, trying to get a sense of, from the purchasing managers, the folks who are making some of the decisions on whether it's manufacturing for supplies, the employment picture, and services as well. What are the things that they're thinking about doing as they look forward? And it's really just a great measure of the current state of economic activity. So on the left-hand side, looking at what the manufacturers part of the economy is telling us based off of what the surveys have been reading, is that you saw going into 2020 and for the most part 2021, a really strong environment for manufacturers. So there was a lot of indication of, again, rebuilding the supply chains that occurred because of the COVID. But as we've seen recently, that pace of growth has started to moderate. In addition to the impact that the Federal Reserve is having on the manufacturing sector, we've finally seen the growth of this sector, at least measured by this index, is going below 50. And 50 is an important number because that really tells is the cutoff of the survey respondents saying that it's growing or contracting from it was previously. So we have more respondents in these indices telling the Supply Chain Management Institute, hey, we're going to slow some of our purchases. We're going to slow growth on a go-forward basis of how they're viewing their own individual businesses. So from the manufacturing side, we crossed that 50. And then as you go to the right-hand side, very similar. Again, this is supposed to be representative of the service sector. And for the first time since COVID time period, we also see the service sector also showing signs of weakness as well. So we have two important indicators showing this, hey, between the Fed and just the complete momentum of the global and here domestically, we're starting to feel that pressure of a slowdown. Then as we go to the next slide, it's always a great exercise we do internally from the overall investment process to look back at the prior year. And sometimes what comes with that review, it's always interesting to see some of the things that you perhaps may have forgot about, things that are a little bit interesting that have occurred throughout the year. And it's hard to imagine anybody would have guessed that we would have saw Will Smith smacking Chris Rock at the Oscars. We had Elon Musk purchasing Twitter. Who would have anticipated the Fed raising rates from 0 all the way to 450, which included 475 basis point hikes, which is incredibly extraordinary. I don't think many folks had on their radar Russia invading Ukraine, causing additional market volatility beyond what the Fed caused. All those concerns that had on the energy prices, grain distribution, the impact that was going to have on inflation, and ultimately we've seen with the inflation environment and how strong growth was. We saw interest rates across the very short end, and then also the U.S. Treasury rates increased rapidly over this time period, where we saw The 2-year yield moved from 73 basis points all the way to a little bit less than 4.5. And then also the 10-year Treasury moving from about 1.5 to just shy of 4% throughout the course of the year. So you've had a lot of disruptions from the marketplace as a result of the Fed policy, Russia-Ukraine dynamics. And it wasn't it's amazing, not the only place that we've seen this disruption is in the short term in the fixed income world. Stock indices had a really rough, challenging year. So anybody's paying attention to the pension fund side of the investment performance certainly have noticed that, whether that's personally or again on the retirement side, have really felt that impact. So as we go to the next slide, we'll a little bit talk about why all this volatility happened. Beyond just the inflation being higher, it's this rate cycle, one of the fastest and strongest that we've seen since the 1983s. And then if we go back again from our investment process perspective, we look back at the beginning of the year with all the dynamics of the pandemic, what the Federal Reserve was communicating. Everybody remembers the transitory description of the price pressures that we were experiencing. Some of the commentary the Fed had as they came out of the prior hiking cycle, they wanted to make sure when they're looking at forward expectations of the economy and what they're going to do with the interest rates, they want to make sure the labor markets are all inclusive. They don't want to see just a low unemployment rate, but there's subgroups that are not participating for various reasons. They learned that coming out of the last cycle, that perhaps they moved too quickly. So as we came into this year, a lot of market participants were really anticipating this hiking cycle to go very slow and methodical, similar to this graph shows on the very bottom, is that 2015 hiking cycle, where it took us a little over 3 years to just get a little over 2%. This was really the base case expectations for just about everybody, including the Fed and within the marketplace. But as the far left hand will show, we got quite a different outcome with this being the fastest in terms of of how high interest rates have gone, and then one of the fastest paces that we've seen as we look to this prior slide of having 4 3/4 of a point increase was quite extraordinary. Typically, we've only seen that those moves 1 or 2 times within any given cycle, but having experienced those 4 was certainly extraordinary and relatively unique. Now, as we see that the red dots over here on the left-hand side pointing to the Fed recognizing, as we'll continue to go through, is perhaps their job's not done. Even though this was fast, they've made a lot of headway in their view of just this last December of where inflation currently stands and where the economy is projected to be. They view very strongly that they still have work to do in getting to a little over 5% and getting to a spot where they think it's a great probability for them to achieve their long-term goals of getting inflation back down to that 2% level. And then as we go to the next slide, we'll walk through back to some of that growth story of what's the unemployment picture look like at a national level within the state of Ohio, then at the county level. So as we see on the far right-hand side, coming out of the pandemic, the labor markets were incredibly strong. I know we've talked a lot about in past of how tight this labor market is, and you really got to see that in the green bar on the national level, where we've seen jobs come back on and come back quite strongly. There's been an incredible amount of news articles and economic reports talking about the number of job openings for available workers is 2 times the amount. So we've had a really big thirst for labor coming out of the pandemic, and really seen that in the case here across the state, where the unemployment rate has certainly come down to align with the national level. And just here recently at the county level, that gap has certainly closed from being a little bit above Ohio in the national level and starting to get much closer to the December time period of 2022 when it coalesces with the rest of the national and Ohio level. So starting to see, or really seeing that further success that the county is having on the unemployment in the labor market side, as we've seen at the national level. And as we go to the next slide are 2, I think these are 2 slides or 2 charts within the slide that really hone in a lot of the data elements of what the Federal Reserve is looking at. Both of these come directly from Jerome Powell. He gave a speech in November at the Brookings Institute, really laying out in addition to what they do on a quarterly basis, and then every time they have these FOMC meetings, he in his speech gave the market a clear indication of a couple variables that they're keeping a very close eye on to, one, highlight some success that their campaign is having, then also point to the areas where they view there's still work to be done. And then we'll start first by going through some of the areas of success. And that's really the left-hand side. And this is a little, we'll try to stay away from too much of the weeds in walking through, CPI methodologies. But the important piece is shelter and housing. It's a huge component of CPI. And what's been occurring here is everybody's experienced housing prices have gone up significantly during the pandemic for a lot of different reasons. We've seen the flight to some of the suburban areas and people moving away from the bigger cities that have driven a lot of the home prices up, and also has had an incredible impact on rents. But with the Fed raising rates as strongly as they have, they've certainly had an incredible impact to the housing market. And it was just a little over about a year and a half ago where individuals were able to get mortgages at 2.5% to 3%, and now we've gotten close to 7%. It's recently come down to 6%. So with that cost of being able to borrow to purchase a home, you've seen that impact across all the housing market, not just on new home purchases. CPI or just rents in general have started to come down. So you'll see more real-time indicators like we have here, this little green bar showing Zillow being a service and provider I'm sure most folks are now comfortable with and knowing. They track the rental prices, and these are much more real-time. The way the CPI is calculated, it takes about 4 quarters for rents that are happening today to actually feed into the CPI calculation. So you can see here, we've seen real leading indicators like Zillow point to, hey, rents are growing at a much slower pace, and it's really expected over the course of this year, as those prices are reflected in the CPI numbers, is that this shelter component of inflation should start to come down, along with other sectors we've seen having some of that disinflation aspects to the inflation environment that we've been experiencing, better than expected readings. Now flipping over to the other side of an area of certainly great concern for the Fed, and what the Fed is really worried about in terms of what is the risk of them not being able to achieve their 2% target, is their concern is on the employment in the labor market, and that being as strong as it has been. As you can see on this chart, there's 3 different measures. One is their preferred measure. It's called the Employment Cost Index. You have an Atlanta Fed produces a wage growth tracker, and then there's average hourly earnings. Certainly, as everybody has tried to hire and experience the labor markets last year, it's certainly been very challenging getting the job applicants, and then recognizing the competition is so fierce that it's caused a lot of businesses and anybody hiring individuals to had to made it more attractive for them to switch jobs. You've certainly seen that reflected in these measures where wages have gone up significantly. And in the area why this is important for the Fed is when you look at the service sector, and the services is really driving today that inflationary environment, is one of the biggest components of cost for the service sector is wages. That's the largest share of an expense. And what they need to see is they need to see wages start to come down to levels that are more consistent with that 2% inflationary environment. And some of the good things, and the Fed has certainly recognized, and the market is recognizing that we've likely, at least by looking at these three measures, we certainly have peaked. And we're certainly seeing signs of, in the last couple of months, that the wage growth is starting to come down and be more consistent with that 2% target. So average hourly earnings is starting to come down. And then this just last week, the employment cost index showing another level that is lower than previously. So you're starting to see some of that success on reducing the wage growth. But again, this is what's going to be a big theme for 2023 as the Fed is trying to get back to 2%. The real key is looking at the labor market. Their goal, as they laid out in December through their summary of economic projections, is to increase the unemployment rate. We really need to loosen the labor markets in order to get the wage growth to come down. So the service sector costs will come down as well, and we'll get closer to that 2% inflationary environment. And as we go to the last slide on the economic front is try to bring this all together. So at the very bottom hand, you can see just really how dramatic and and fast that if you just look at December 2021, how low interest rates were, and then going all the way back to the top of the page, seeing the shape of the yield curve is different, but the overall level is significantly higher, and that's reflecting what the Federal Reserve has had to do to get rates higher in order to reduce growth and to try to bring this inflationary environment that's been historic back down to a normalized level. But the part that is, well, there's two aspects that it's been with the top parts, whether that's the orange or the little other blue color, teal, I believe, as we'll say, is the shape of the yield curve. So the shape of the yield curve is really important because it has expectations both for growth and it has expectations for on the inflation front. Now, in both of these cases at the very top, you'll notice that, hey, the short-term rates are higher than these longer-term rates. So the market is expecting that over a short period of time, the Fed is going to have to adjust policy as they reach either, we'll call it success, in that they're able to keep growth keep growth growing, but also bringing inflation down. They're going to have to adjust their policy rates lower, or they're going to keep policy rates elevated for a significant period of time. And in order to get the labor markets to loosen, they're going to cause a recession. But in both versions, they're going to have to reduce interest rates at some point in the future. And the market's really anticipating on either case that the front end rates are going to come down and the Fed's going to have to be accommodative at some point into the near future. And we've certainly seen with some of the success we talked about in the inflation front, that this idea of peak yields, where this orange bar will show that was the peak level of interest rates across the yield curve. As we've seen inflation coming down and some of the loosening up in the labor markets, there's been enough success that the market's getting very confident that rates are not going to go materially higher from that October period. And folks are looking at the interest rate environment and saying, looking back and recognizing this is the highest levels we've seen in more than a decade. It's an incredibly attractive opportunity for fixed income in general to be able to lock in some of these longer term rates, even though front end rates are really high. And some of our liquidity options are higher than these longer term rates, but being able to lock in funds for 5 years, it provides a significant advantage than sitting in cash for the same time period. And then with that, on the economic front, I'd love to open up for any questions before we dive into the portfolio.
Yeah, thank you, Mr. Chairman. On your ISM Manufacturing Index dropping below 50, it's my understanding, though I don't have access, of course, to the information, the president tomorrow night is supposed to, in a State of the Union, be singing the praises of manufacturing. How do you reconcile what, I assume you don't have that, do you guys get access to his published comments? I know some of the media does. My understanding is he's going to be talking very much about the growth of manufacturing and the success.
I know
any feedback about why it's crossed over the 50?
So we don't have access to what's in the speech side of the house, and don't have an insight into what his comments will be. I think to me, the manufacturer side is a reflection of globally. We're slowing down. There's definitely some impact to China being shut down for a period of time here in the last late Q3 and also into Q4, where with their zero COVID policies certainly had an impact across the global economy, and certainly definitely has impacted folks domestically. There's certainly been signs of them reopening up, but there's been some speculation of what that really means, not similar to US, but something between zero COVID and somewhere in between. That's certainly weighed on manufacturing globally, but certainly has had an impact on the manufacturing side in the US. But I think more broadly, it's more consistent with the expectation that with policies being as tight as it, a level of interest rates going as high as it has been, that's having a significant influence on the growth trajectory and the business uncertainty that exists out there with the level of rates that we have here. I mean, the goal is to be restrictive and the goal is to reduce economic activity. That is the Fed's objective, and that's necessary to get inflation back to 2%. And their reason for that is they think having inflation having that price stability will give more certainty for businesses over the long run. So they're willing to accept some short-term pain, whether that's slowing growth and loosening the labor market in order to have a more longer-term successful environment.
But ISM doesn't measure Chinese economic activity. It only measures exports to China in that respect. Is It would only be our selling to that. This is a US index, is it not?
Yes, we don't have there's each country,
When you said global, I don't know, I wasn't understanding how you're linking that back to our US manufacturing in that, with that.
Oh, yeah, because so it's gonna be both the exports and the imports, so the both sides of that will have a flavor of the respondents into the survey respondents.
It'll be interesting to see. I would tend to think it's gonna move back up, but very quickly. Thank you.
Mhm.
Mr. Chair, Jason, Eileen, thanks for the report so far. This is my favorite part where we get to talk about the macro trends and just look into your world a little bit. I have 3 questions, none of which I expect you necessarily can put the perfect fine point on, but on the wage growth and inflation reconciliation, what do you make of the extra 1.5%? I mean, that's a pretty large variance, 2 to 3.5 versus the 2 at inflation. Which is chasing which, I guess? Are we trying to catch up with inflation by over adjusting on wage?
Well, I guess they're really, I would say they're more consistent.
Okay. I mean, I'm asking it almost as a practicality to how we consider employee wages and adjustment to inflation. But again, I can take that offline a little bit. Yeah. Do you understand the nature of the question, though?
I think so.
I could just add, I think, when we look at those wage inflation numbers, we also want to keep in mind that takes into account increases in the cost of benefits. So it may not be just strictly wage.
That's helpful. Yeah. Makes sense. On the rent side, does rent ever really come down at the, I mean, you're saying rents are expected to fall, but matter of what degree? I mean, to me, a rent curve is always kind of moving upward, just a matter of slow dips down, but bigger climbs up.
Yeah, it's actually, so if you go back to that chart, it's really the growth rate. So the growth rate's just slowing. We're not having experienced the actual rent falling.
The diminishment of rent, appreciation or something.
Yeah, we're really looking for a disinflationary environment, and not outright deflationary environment.
Okay. And then the last question.
That's a good point, because many times when we think about inflation falling, the expectations are that prices will drop.
Yeah.
But in essence, as Jason had said, the way these measures work, disinflation is just a reduction in the increase in prices. And, that is really what the Fed is looking to achieve, is that the increase in prices reverts back to close to the 2% target.
Mm-hmm.
Clearly during the beginning of, the COVID, there was some concern about the prospect of deflation, which would be falling prices. Yeah.
And then finally, thank you. Overall economic activity, as we rely a lot on sales tax, it's just expected that overall economic activity will not be deflating. It'll continue to move.
Oh, so this is the area that's been probably one of the more fascinating aspects of it. Is this entire, I would say most part of 2022 was expecting, consumers to pull back on their spending. And it's one of the biggest surprises that have kept growth elevated in this sort of quote soft landing possibility to be achieved by the Fed. And so far we've had bank earnings just here recently in the 3 major banks between JPM, Wells, and Bank of America. They cover an incredible portion of the consumer base. And they continuously reporting strong spending numbers on the consumer side. And part of this is spending down excess savings that have existed from the pandemic. So as we see, and again, going back to the big key for the Fed and the variable everybody's looking at for this inflation success is going to be this wage side, because that just feeds back to the ability for consumer spending. And if wages stay elevated and the growth rates don't come down, consumer spending will likely continue to be strong, and we'll be in the same spot.
I feel like we at Cuyahoga County sort of spin plates on all 3 of these sticks. So thank you. Appreciate it.
Welcome.
And the irony of that is that as inflation goes on, unless you change the methodology to what is being taxed, we're the beneficiaries of that.
Right. Yeah.
Because we're getting tax dollars on an inflated purchase of an item. And so and the people are still buying those items.
Yep.
begrudgingly at a higher cost.
Yeah.
All
Thanks.
right, any additional questions or comments?
Elaine, how did you get on there? Because I thought you had to be the name Jason to be one of our presenters of the, Jason Click, Jason Heading, now Jason. I thought maybe you had to be a Jason to be part of your presentation team, so little levity there, sorry about that.
That's a good one. I really appreciate that. Yeah, I like to say, I guess I'm a little bit of a rebel.
Well, Chris wouldn't know that because this is his first meeting, and all of our other presenters have always been Jason. Jason. This is our, yeah.
8
Yeah.
years. 8 years, yes. Go ahead,
Great.
Eileen.
All right, well, perfect. Well, let me change gears here and do the review of the county's investment portfolio and really talk through, how we're applying many of the factors that Jason had covered in the economic review. So first of all, we have here on this page is a chart of showing the change of the county's cash as well as the core portfolio. So as we know, funds are maintained in the cash and cash equivalents to meet operating expenses and any short-term needs, and excess funds are then allocated to the core portfolio. When we look at this chart, we can see that the cash and cash equivalents have spikes periodically, and those spikes correlate with when the county is in the process of collecting real estate taxes. And so as those taxes are collected, they're maintained in the cash and cash equivalents portion of the county's portfolios. And then as they are remitted out to the school districts and other local governments, then that cash and cash equivalents drops. So on a periodic basis, then there is discussion with the treasurer's office about the appropriate allocation, we would say, on a more normalized basis between what is kept in cash and cash equivalents versus dedicated to the core investment portfolio. And as we can see, as of the end of 2022, there was $920 million that was allocated to the core portfolio. This slide provides a snapshot.
Yeah, if we could just stop, sorry, Elaine, but
That's okay.
the county executive's point on that last conversation, just draw a straight line from January 2018 tip to December, and you can see how much inflation has already even moved in the real estate cycle. I mean, our funding cycle is directly reflected upon that. If you just draw a straight line across that, it's, yeah. It's one of our sides that we benefit from, as long as we use their money correctly.
Yeah, clearly, I think that points to, as Jason had mentioned, the inflation we've seen in the housing prices, and of course that has trickled down into the valuations, which is works into the calculation of the real estate taxes that are collected. So yes, clearly the increase in housing prices has benefited the county as a whole. Okay. Moving on to, as I said, the snapshot of the core portfolio, which what this slide does is it gives us an indication of, the $920 million, a few statistics, metrics as it relates to the portfolio, our asset allocation, and the maturity distribution. So taking a look at the metrics, the portfolio as it stood at the end of the year had a weighted average maturity of a little bit over 2.5 years. So when we think in terms of the Ohio Revised Code, which limits most investment options to a 5-year maximum maturity, this would be about the midpoint of that 5-year maximum maturity. The portfolio is currently yielding 1.85%, and this will generate for the county about $17 million of interest income on a 12-month forward basis. When we look at the asset allocation, we are concentrated in U.S. government agencies with a 48% of the county's investments in that asset class, balanced by another 0.25% of the portfolio in U.S. Treasuries, and then adding on other permissible asset classes such as commercial paper, municipal securities, forward securities, and the corporate notes. Looking at the maturity distribution, we can see that the portfolio is currently structured such that we have 31% of the portfolio maturing beyond 3 years. This 3% that is maturing beyond 5 years represents the manuscript debt that had been issued some time ago for the garage project, and that is held by the Treasurer's office. From an investment strategy standpoint, considering that we are starting to see some slowing in the U.S. economy, and we have the Fed, very focused on continuing that trend, we will be looking to continue to add investments out beyond this 3-year period here, so that we can lock in the current interest rates that are available, and therefore provide some stability to the county's interest income for a longer term basis.
Elaine, while we're on that slide, just again, for purposes of the county executive, this is his first meeting. We have one slice that's in foreign securities. You might want to touch on that because I just think it's important for him to hear.
Yeah, I was going to ask, thank you.
Sorry, I didn't mean to be butting in, but I just wanted you to at least
Yep.
know what the substance
Thanks.
was.
Sure, absolutely. Good question. Yes, Ohio Revised Code does allow counties to invest up to 2% of their investment portfolio in securities issued by foreign countries. And in this case, this represents bonds that are issued by Israel. So those are a permissible investment. And as we can see here, we have maximized that investment opportunity as it does add some value to the portfolio.
And at what rate?
I want to say 3.5. give or take.
Yeah, I would say, yeah. I would have to look at the detail to see when those were purchased, but I do know as most recently when they have come to market for some of my other counties, yeah, the rates have been very competitive compared to other investment classes.
But higher than the 1.85 you're showing on this
Yes.
slide for our
Absolutely.
general
Yes.
fund. Okay, I just,
Yes.
thank you.
But we're capped
Yeah.
at 2%.
Yeah.
That's the issue.
And the question I was going to ask is whether that 2% had ever changed since the inception of the new county government, one way or the other. Okay, I'm just curious more than anything. Thanks.
Any other questions?
I think that's a constraint from the Ohio Revised Code. I think.
Yeah, it's ORC.
But
Yeah.
the questions always come up from the media will be on the 2% being Israel. Why do you just use Israel bonds? And our performance is far exceeding what we get out of other
Anything
funds.
else? Right.
Thanks.
Yeah, and there are some other criteria as it relates to the foreign debt that a county can invest in, and the Israel bonds happen to, number one, meet that criteria, as well as offering, as I'd said, a competitive return.
Mr. Chair, if I can just add for the committee's knowledge too, I mean, this is relatively new. Councilman Tron and prior county executive, they added that to the investment policy. So prior to that, it wasn't available because the committee actually had to take action to include that in our own investment policy.
Okay.
That prior to the change or after?
This, under the new government, Tron, you and Armin changed our portfolio to allow that investment.
My point was only
I was
the interest
already
rate.
here.
so
I know
maybe
you weren't looking, but I
it was
just,
just earning more money for us.
yeah, in terms of how new it is.
Yep.
Just the background there.
Thanks.
All right, moving on to the performance of the portfolio. We have two indicators here that we compare the yield on the portfolio to. The county's investment return is represented by the dark blue line. And as we can see, the orangish line, that is Star Ohio, which is the overnight investment pool that the county can invest in. And that interest rate has skyrocketed. It basically has mirrored that fastest pace of Fed action that we covered in one of the earlier slides. So since Star Ohio has to maintain a very short-term maturity limitation, that interest rate on Star Ohio is able to react very quickly to the movement in overnight interest rates. So the benchmark that's had been chosen to gauge the county's investment performance is the green line. And this benchmark is a 2-year moving average of the 2-year constant U.S. Treasury yield. And so what this does is by using a 2-year yield and a 2-year average, it basically matches up, aligns with the duration, the average maturity of the county's investment portfolio. And so as we can see, it is much slower to move up in reaction to this very abrupt movement we've experienced in short-term interest rates, which is very similar to how the county's investment portfolio will move as well. As we had noted, the average maturity on the county's investment portfolio currently stands at around 2.5 years. All right. Moving on to the opioid settlement portfolio. So this is the $60 million that is dedicated to an investment portfolio. As noted earlier, there is the additional $35 million that is maintained in cash. And as we look at the $60 million, it has a much shorter weighted average maturity of 1.5 years. And that is because as the opioid money was received and then invested, the bulk of the funds were invested to match a draw schedule for a construction project that is affiliated with the opioid problem. The weighted average yield on the portfolio stands at 1.61%. So again, on a 12-month forward basis, the portfolio will generate just under $1 million worth of interest. Asset allocation is a little broader spread, and this is just by nature of the fact of when perhaps the portfolio was funded, where we have 40% in government agencies, 32% in treasuries, taking advantage of commercial paper and corporate notes as well. So when we look at the bottom section of the snapshot here, we can see that there's 51% of the portfolio maturing within a year, and that is purposeful based on the expectations that the building project expenditures will occur during the course of the next year. And then the balance of the monies are spread out here over the next out to 4 years. And it's our understanding that these monies represent funds that would be needed to operate the center.
Elaine, sorry for asking a question. Are you saying building or building project for the 51%?
Building. It's my understanding building.
With a D?
Yeah.
Okay.
Yes.
All right. So what building project is that going towards?
I believe it is a reentry building project, but we've got as Eileen stated, our goals and aims with the portfolio is based on a draw schedule that we had. Now that draw schedule might be outdated. Yes, absolutely.
I mean, if we can be earning 4% at Star Ohio,
Right.
and we ain't using this money for a building
Right.
as opposed to a billing, I always thought maybe, man, that's a lot of money sitting out there.
Right.
It makes your $1 million double immediately.
I think at the time, Councilman, there was not a imminent use of this particular money, and so.
Well, I understand that, but
Prudent wise.
I don't recall voting on a building project for around opiate funds.
We do have a draw schedule.
I-
Let me
I-
check.
Am I missing?
Mr. Chair, I think what the long-term plan, year or two ago was potentially set these dollars aside for a diversion center.
Yeah.
I say
but-
reentry, I'm sorry.
Yeah, I figured, Chris,
Yep.
that's what you were referring to.
Right,
But
okay.
again, nothing was voted on or approved. It's
So it was
just,
a possible building as opposed to, okay, thank you.
And I think at the time, rates were not what they are now. So I see your point, though.
It's not the question of the rates, it's a question of, was it a capital building that we were putting in, or is it a building for treatment? And that's it.
All right.
Yep.
Sounds to me as though it was an anticipated building
Building.
that I don't think the council ever voted on.
Yeah, and clearly, right, that would be a point that, as we have our monthly conversations with the treasurer's office and looking at the upcoming maturities and the like, we will be, looking to determine, right, will those funds be reinvested very short term? Or if there is still some uncertainty as it relates to the use of these dollars, would it benefit this portion of the funds to be perhaps locked in for a little bit longer term?
Okay. We'll certainly explore that. Thanks, Eileen.
Yes, thank you. Okay, are there any other questions at this point?
No.
Thank you. With that, I'm going to unshare my screen. We appreciate, again, the opportunity, and yeah, if anything else comes up, I'm sure Chris or his staff will reach out to us.
All right. Thank you. Thank you.
Thank you.
Thank you.
All right. Moving on to other business. Is there any other business before the committee? Okay. Seeing none, I'll entertain a motion for adjournment.
So move?
Second, if you need it.
Been properly moved and seconded. And we adjourn the meeting. All those signify by saying aye. Aye. Motion carries.
Right.
Oh, really?
We'll check.
I thought you had to take a vote.